Why was the post.com bubble investment climate so cautious? Imagine a world where everyone believed the internet would change everything overnight. That was the late 1990s, with stocks soaring and new companies popping up daily. But then, around the year 2000, that world suddenly changed. The bubble burst and everything came crashing down. Investors lost billions and the stock market took a nosedive. So, why did everyone become so careful after that? Well, it all comes down to what happened during that wild internet boom and bust. During the late 1990s, many internet companies had little to no profits but still attracted huge amounts of money. People believed these companies would grow fast and make everyone rich. The Nasdaq Composite Index, which tracks many tech stocks, soared to a price-to-earnings ratio of about 200. That's way higher than normal, which usually hovers around 15 to 20. When the bubble burst in 2000, hundreds of these companies vanished overnight. Big names like Petscom and Webvan went bankrupt, and even giants like Cisco and Yahoo saw their stock prices plummet. This wiped out a lot of investor wealth and made people very wary of tech stocks. Another reason was the Federal Reserve. In the late 1990s and early 2000, they raised interest rates several times to slow down the overheated market. Higher interest rates made borrowing more expensive, so people and companies hesitated to take big risks. This shift encouraged investors to put their money into safer assets like bonds instead of risky tech stocks. People also started questioning whether these internet companies could actually make money. Many had no clear plan for profits and relied on hype and future promises. After the crash, investors demanded proof of real earnings and solid business models before investing again. Global economic worries also played a part. Japan was in recession, and other parts of the world faced economic uncertainties. These concerns made investors more cautious about putting money into risky sectors, especially new internet companies. Market psychology changed too. After seeing the rapid rise and fall of tech stocks, many investors lost confidence. They preferred to stick with established companies that had proven track records rather than risky startups with uncertain futures. Looking back at the 1990s, the excitement about the internet was huge. Everyone thought it would revolutionize everything overnight. But the crash was a wake-up call. It showed that not all innovation leads to quick profits, and that solid business fundamentals matter. This cautious attitude led to more careful analysis before investing. Venture capital funding slowed for unproven startups, and companies had to prove they could make money before getting funding. This shift helped create a more mature tech industry later on, where companies focused on real value. In the end, the post-bubble investment climate was a direct result of the excesses and failures of the late 1990s internet boom. It made everyone more careful, more realistic, and more focused on sustainable growth. That cautious approach helped shape the tech industry into what it is today.